Hello there, this is the Bookkeeping Master on YouTube. Welcome to this video. If this is the first video that you have watched of mine, then a very warm welcome to you. If you are a returning viewer, a subscriber to my channel, then welcome back. I appreciate all the views and support that I can get. This video is going to be about the basics of bank reconciliations, and I'm going to answer some very simple but commonly asked questions about bank reconciliations, such as what is a bank reconciliation and why are bank reconciliations needed. So let's start with that first question. So what is a bank reconciliation, or what are bank reconciliations? So a bank reconciliation, the word reconcile is to bring together or to make one. So what are we bringing together? What are we making one? It's generally the accounting records. So accounting records, that could be records kept on Excel, it could be handwritten records, so that doesn't happen very often. Most accounting records now are kept on accounting software, things like QuickBooks, Xero, Sage, Cashflow, that sort of thing. But smaller businesses can use Microsoft Excel and similar packages to keep their accounting records. So we bring together the accounting records and the bank statements, or the bank account. Now, why do we need to do that? Why do we need to bring the accounting records and the bank statements together? If I said that to somebody, it makes no sense, but that's what a bank reconciliation is. We're bringing those two things together. So why do we need bank reconciliations? What's the purpose of bank reconciliations? Now, the best way to explain why is to give you an example. I think having something visual on the screen will help you understand why bank reconciliations are needed, more so than if I just try to explain on this video using my voice. So we go to sheet 2 down here. I've got two columns here. I have accounting software and I have bank statement, and I'm bringing them together. They're side by side. So we can see here on the accounting software, this is the bank account on the accounting software. This is the bank balance as at 31st of March and 1st of March, and these are the transactions showing on the accounting software. So on the accounting software, or on Excel, or a manual ledger you keep, we have the 1st of March, £500 or $500, whatever it is, there's 500 of something on the 1st of March. And then during March, someone has added, probably the bookkeeper or the business owner, they've added a payment to a supplier, ABC for £50, so minus £50 paid to the supplier. There was money received from customer XYZ for £100, and there was a payment to a water company minus £150. And then, according to the accounting software, the records we're keeping, the bank balance at 31st of March was £700. Now, if we actually look at the real bank account, so not the accounting software, but the actual bank account, that's usually done by bringing the account up online or viewing a bank statement, you can see the balance on the 31st of March was not £700, but £1,346, or $1,346, whatever the currency is. So there's a discrepancy here. The accounting software does not match the bank statement. And this is the reason why you need to do a bank reconciliation, because every transaction that is showing on the bank statement will not appear on the accounting software. It could be that a bookkeeper is entering payments as they're making them and entering money received into the account as they're receiving remittance advice from customers. But what happens if a director makes a payment to a supplier, say, and doesn't tell the bookkeeper won't know about it? Or how about a customer makes a payment into the bank account but doesn't send a remittance or an email to say they've made payment? How about things like bank charges, or a director going out and paying for a meal who's entertaining some clients or some suppliers? He puts that on the business debit card that goes through the bank account. The person recording the transactions for the bank account on the accounting software is not necessarily going to know about all these different transactions. So this is why we need to do the bank reconciliation, is to ensure that everything that's going in and out of the bank will be showing on the accounting software. So if we look at the beginning here, 1st of March 500, 1st of March 500. Okay, so the beginning balances match. So let's just highlight them. We have payment to supplier ABC minus 50. That's shown on the bank statement here. We have payment from customer XYZ, £400. That is showing here on the bank statement. And then we have payment to water company minus £150. This is showing here. Now the transactions that are not highlighted are the transactions that are missing on the accounting software, such as this money received from customer TUV, £400, a debit card transaction, ABC Stationery, £250, a bank charge, minus £5, and bank interest received, £1. So these 4 transactions will need entering onto the accounting software. And when that is done, if we were to post these transactions onto the accounting software, we would find that the bank balance is now 1,346, which is the same as the bank statement. So our bank reconciliation is now complete. We've reconciled the account software to the bank statement. They are matching, they are the same, and that's the end goal of the bank reconciliation, is to have the account software or the accounting records match what is actually happening with the bank account. Now, if you have any questions about that, feel free to drop me an email. I have plenty of other videos about the basics of bookkeeping and accounting. Please just go through my YouTube channel or visit my website, freebookkeepingaccounting.com, and there are plenty of free videos. I have over 200 free videos about bookkeeping and accounting. Now, the other question that's worth answering in this video is it just bank accounts that are reconciled? The answer is no. You can reconcile supplier accounts. So what you may have on your accounting records or accounting software may not match what your supplier has for that account. So the way you would reconcile a supplier account on your accounting software is to reconcile what you have on your accounting software to a statement sent by your supplier. It could be that there are payments missed off the statement. It could be that there are invoices sent that you did not enter onto the account software, or that were not entered onto the account software. So there's a discrepancy there. The balance of that supplier account may be out. So you can reconcile those supplier accounts. You can also reconcile customer accounts. You can reconcile tax accounts. Tax charged to the business or company and payments made. You can download statements from your local tax authority and reconcile that statement to what you have on your account software. You can also reconcile director accounts and any other account you can think of. All these things generally can be reconciled and do need reconciling on a regular basis. Reconciling accounts helps to ensure that records are accurate and that there are no discrepancies on the accounts. As I mentioned earlier, if you have any questions about bank reconciliations, please check out my website. Feel free to drop me an email. And also check my other videos on my channel. They may help you and provide a bit more information about bookkeeping, accounting, and bank reconciliations. If you want to see a live bank reconciliation in action, then I'm in the process of uploading a series of videos about doing a bank reconciliation on QuickBooks Online, which is accounting software. Feel free to find that video. I'll put a link in the description below, and you can watch an actual bank reconciliation take place. Thank you so much for watching. Please like, please subscribe, and please watch more of my videos.